that move to the downside Monday may be causing some hurt for investors, seeing that line in your brokerage account tick a little bit lower. So let's talk about it with Jeremy Bryan, Gradient Investments Senior Portfolio Manager. Jeremy, great to have you here with us. I mean, first of all, let's put this in context. It was slippage, but we haven't erased all of the gains. So what were you telling clients over the past couple of trading days here?
That's exactly right. Context is important here. We did have, anytime these types of activities happen, and especially when they happen on an accelerated pace like we saw here recently, you have to kind of pull yourself back and give yourself a little context. Is that the market, even after this correction, is still up over 9%. That's in line with long-term averages. And secondarily, since the end of last September, we're up nearly 30% during that time. So, I think people generally and should absolutely have questions, concerns, try to understand what's going on, but also take it under the assumption that we've had a really strong rally here and that corrections happen quite frequently. It's usually the abnormal part is that 30% that we don't experience a correction, right? So volatility is a natural part of the overall stock market. It's a natural part of investing. It happens quite frequently. You usually just have to kind of weather the storm, and you usually end up more prosperous on the other end of it.
What is a good rule of thumb or even tips for how to invest amid a downturn?
Right. I think the biggest thing is understand your level of risk and what you're trying to accomplish. When you see big rallies like we've seen over the past 6, 8, 9 months, a lot of people can get away from what their natural investment plan is and start to chase returns because everything looks like it's going up, right? You see the neighbor, you hear the neighbor getting rich and all of that stuff, and you start to do things that are absent and away from your investment plan. I think when you have things like this, it's a natural component to obviously be concerned, but secondarily to just take a breath and understand where you are from a risk objective and does it fit with your overall plan and what you're trying to do with your money.
Absolutely. And so for the stocks that perhaps, even if there are some risky assets out there, as we've been talking with analysts and strategists over the course of this morning, they've been giving us where they line up on where to perhaps bite into some risk right now at discounted prices and where to still kind of stay on the sidelines. How are you evaluating that?
Yeah, it's a fantastic question because I don't think generally stocks are what I would call in the bargain bin yet, right? Is that we've been quite expensive, to be honest with you, in the markets. Markets are above their 5 and 10-year average valuations. So it's not like this correction has created an ultra cheap market, right? So really you do have to kind of pick and choose your battles, and you have to understand where you think opportunity is. And I think that under two thoughts here is that one, where is growth going to continue in that space? If the market does slow down or the economy does slow down a little bit, who are the companies that can continue to grow during that environment? And what am I paying for those companies? And I think that's where you can find some things in the bargain area. Is a company that really fits that to us is something like Cigna, right? Which is a massive health insurer. They're going to continue to grow probably this year and next year quite well. And the stock is at a near 10 times, next 12 months earnings multiple. That's a pretty cheap stock. Those are the kinds of bargains that we're looking for on our side and saying, what can we use as this temporary dislocation to take advantage of because we still think the company is in a healthy spot. And now we're paying a much cheaper valuation to where we could get upside going forward.
And on the other side of that, are there names that you wouldn't be touching with a 10-foot pole, regardless of a bargain bin level?
The only thing I would say be cautious on is something that's had, a 5 and even 10% correction, but it has rallied 130% over the last 9 months. Just because it's had a little bit of a correction here doesn't mean that it's an automatic buy. Is that, especially companies that have had material changes in their growth profile going forward, that's where we would be most cautious in saying, it's corrected here 10%. Well, if the valuation is still excessively high, it's just not quite as high as it was before, and also the growth profile is having some difficulties, those are areas where I would still say, where you're trying to avoid the falling knife is that transition from growth to value, which can be quite painful and usually lasts a lot longer than people anticipate. Those are the kinds of areas that we would just be a little bit more cautious on right now. So again, just understanding what you're owning, understanding we came from a very expensive market, and that even this correction, some of those stocks still might be quite expensive compared to what their growth looks like.
Jeremy Bryan, who is the Gradient Investment Senior Portfolio Manager. Jeremy, thanks so much for kicking off the show with us. Appreciate it.
Thank you.